So if you specifically chose smart money concept to be your way of saying the market or analyzing the market, then this video is for you. We have many ways of analyzing the market. We have many ways of saying the market. But if you chose SMC specifically, then this video will be so beneficial to you, because in this video we are going to be talking about everything a beginner should know about SMC. You may not be a newbie, but there's some things you may not know about SMC, and this video is going to treat all of them, so stick along. The first thing you want to know about SMC is, what is smart money concept all about? What is inside? What is this? That's the first thing. And smart money concept is how traders, big traders, banks, institutions see the market. They don't see it like how retailers, as retail traders like me and you, see the market. No, they see it in another dimension. They see it in another way, and that is what smart money concept is all about. Seeing it in a way big traders see the market, seeing it in a way big institutions, banks see the market, is what we call smart money concept. So under smart money concept, we have some things, like up to 8 things or 7 things we're going to be dealing about under them. And we're going to start with number 1, which is market structure. If you don't understand the language of the market, you will not be able to prosper in it. Because let me say I want to follow my friend, but I don't know the direction she's going. She can, like, I don't understand the language she's speaking, so I'll not know the direction it's going. Maybe she's trying to say left, maybe say not in English, she's saying left in another language. I'll be thinking maybe it's right, or she does not, or she's speaking rubbish. The same way, if you don't know the language of the market, you will not be able to know what to do next. You will not know the direction of the market. You will not know how to understand the market, and that is where market structure comes in SMC. Market structure is all about understanding the direction of the market, understanding what the market is doing, understanding where the market is going. That is all about market structure. It involves knowing the movement and everything. Just understanding what the market is doing at that particular time is what we call market structure. And under market structure, we have what we call trends. And we have 3 types of trend: the uptrend, the downtrend, and the sideways or ranging trend. These are the 3 types of trend. So let's deal with them one after the other. We have uptrend. Uptrend is forming higher highs and higher lows to the upside, as the name implies. Downtrend forming lower highs and lower lows to the downside, as the name implies. And sideways trend moving from left to right, not breaking either up or either down, ranging sideways, also as the name implies. So once you can understand, okay, you look at this chart, you look at this market, and the market is moving to the upside, you look at it and moving to the downside, you already know the most important thing about analyzing in SMC, like smart money concept. You know the number 1 most important thing is that know which direction. Market going up, the market going down, market moving from left to right, that is ranging. So the number 2 thing is going to be break of structure. Break of structure. And what is a break of structure? A break of structure is, as the name also implies, is the breaking of a previous level. It's the breaking of a previous structure. Let me use this example. Alphabetical order. I was in letter B. I came down to letter A, and I went up. Instead of me going back to letter B, I went straight to level like letter C. You see that I broke the level which I was before and entered another dimension. That is break of structure. For you to create a new level, a new structure, is what we call break of structure. If it's an uptrend, we are looking for break of structures to the upside, breaking up towards the upside. If it's downtrend, we're looking for break of structures to the downside, breaking levels to the downside. And if it's a sideways trend, it does not have break of structure. So break of structures are only found or valid when it's uptrend or downtrend. By the time it's a sideways trend or a ranging trend, do not just, and in fact, don't even look for anything break of structure, because normally in SMC we don't analyze, we don't trade ranging or sideways trend. Just note that. The next thing after break of structure is going to be order block, or we call it zones. But let's start with order block. How do I identify an order block? Or let me say, what is an order block? An order block is what attracts the market to a particular level. The market is in E and the order block is in A. The market will have to come to letter A before going back to F. That the order block attracts the market to a particular level that it has already passed, but it attracted to that level so that traders can enter there and follow it to wherever direction it is going to. That is order block. So it attracts the market from wherever direction it already is, or wherever location it already is, to a particular location so that traders can follow it and move on. That is order block. So how do I identify an order block? An order block can be identified by an impulsive candle. Oh God, why are you saying that? What is an impulsive candle? You just pick another one. Okay, let me explain. An impulsive candle is a long candle. A long full body candle is what we call an impulsive candle, or an impulsive movement. It can be bullish, which is buying, or it can be bearish, which is selling. As far as a full body candle, it's called an impulsive candle. So the last candle before an impulsive candle is always the order block. Under what you're, how do you look for it, or where is it located? It is right in the break of structures. When a break of structure is formed, we start looking for the order block. If the break of structure to the downside, we look for the order block. If the break of structure to the upside, we look for the order block. And I said the order block is identified by the impulsive candle formed close to it. So the candle short, sometimes is a short candle. The short candle formed before an impulsive candle is what we call an order block. As I said, we call it zones too, and let me explain that. If it's a bullish trend, if it's buying, if it's an uptrend, it's called a demand zone. We generally call it order block, but if you want to be more specific, we call it demand zones. Why is it called demand zones? Because that particular zone attracts buyers. So when the market comes to that zone, it starts buying. That's why we call it demand zone. And if it's a bullish and bearish trend, that is downtrend, we call it supply zones. Why? Because that particular zone attracts sellers. So that's just it. If you don't want to stress yourself, you can just call it order block. Simple. It's the same thing. So the next thing we're going to be talking about is fair value gap. You remember the impulsive candle we just talked about just now? That's what we're still going to be talking about today. For an order block to be valid, it must have a fair value gap, short form FVG. For an order block, demand zone, supply zone to be valid, it must have what we call a fair value gap. What is a fair value gap? A fair value gap is what makes an order block valid. It's the market. It's the magnet that attracts the magnet. An order block alone will not attract the market, but that magnet attached to the order block is what attracts the market. You can have an order block and there is no magnet, the market will not come to that level. But when there is a magnet attached to the order block, the market comes down. So an FVG here is the market. And how do you identify an FVG in the market? That impulsive candle we talked about mostly forms the FVG. Why? Because when a body of a candle is formed, a full long body of a candle is formed, there will be an order block in this level and another level the candle, so there will be a space. So FVG can be defined as a space in the market which the market comes down back to that particular place and fills before going back to the direction it was. No matter direction, downtrend or uptrend, it comes to that direction before going back to whatever it was doing. So that space in the market becomes the magnet that attracts the market. So an FVG is an essential thing in SMC. Why? Because if there is no magnet, the market will not come down. So there must be a magnet for that order block to be valid. You have a break of structure, you have an order block. If you don't have FVG, there's a probability the market will not come down to that level. Then the next thing is what we call support and resistance level. Support and resistance level. Remember we talked about the third type of trend, which is ranging or sideways trend. It is what forms resistance or support level. Let me put this example. You have a ball and you bounce it on the floor. Immediately you bounce a ball on the floor, it bounces upright. That is the same thing in the market, and that is the support level. It's the floor of the market. When you see the prices come to that particular level, it does not break to the downside, it continues bouncing up. It comes to that same level again, it does not break, it continues bouncing up. That place becomes a support level. It becomes the floor of the market. Then if you have a level, the upside, if you bounce a ball to the roof, it bounces to the roof and comes back down. It does not, if the ball does not bust the roof, it bounces and comes back down. That is also same thing as resistance level. It becomes the roof of the market. You see market price go to that level and comes down. It's not able to just break that level. It's like there's a strong hold in that level. It's not able to. That makes that place a resistance level. The market is not able, till the market is able to break that level, it forms a break of structure. But if it's not, it forms resistance and support level. So in a ranging market from left to right, it is support, it's a resistance and a support level. It's not breaking to the up, it's not breaking to the down. Makes it a support and resistance levels. Then the next thing is what we call change of character. You know, I defined order block as what attracts the market before the market starts continuing whatever it was doing before. There are times that the order block does not hold the market. At times the order block is not strong enough to hold the market, and that makes that place a change of character. For example, it's an uptrend, we have a demand zone or we have an order block, the market is supposed to come and touch. But when the market reached there, instead of touching it and going back up, it touched it and broke it. That makes that place a change of character, meaning you were buying before, but now you start looking for how to sell in the market. That's just the definition. Same thing for downtrend. A downtrend, the supply zone was formed. Instead of the market to touch that supply zone and continue selling, it touched the supply zone and broke it, forming a change of character. You start thinking of how to buy, meaning the order blocks or the demand or supply zone was not strong enough to hold the market. The market decided that it want to change what it was doing, it want to change direction, it want to start doing the opposite of whatever it was doing in the past. Then we have liquidity, and I think this will be the last under SMC, and it's not the least because it's a very important thing, and you used to deal with most traders if you don't know it or you don't know how to identify it. Liquidity is what big traders use to attack retail traders. It's not like if they're using to fight them, no. Just that when retail traders place a trade and they put their stop orders in one particular place, banks and big institutions see it as a way of getting more profit. So they sweep the entry off, enter the person's entry, the person is in losses, then keep the person out with hitting the stop loss before moving on the trade direction. So big banks, institutions, they use this thing a lot. Liquidity, they use it a lot. So how do you identify liquidity? When the first thing is to know the valid order block. Know the valid order block in a break of structure, because if you don't know it, you will become the liquidity. In a break of structure, there's always a fake order block and a real order block. A fake order block, now there are fake products and there are real products. Same thing, there are fake order block and there are real order block. So the thing about you trading is for you to identify which is a real and which is a fake. Because liquidity is something that you analyze that this market is going to buy, but you enter at the wrong place and at the wrong time. So when the market comes and kick you out, you think the thing wants to start selling, but no, by the time maybe it kicks you out and you enter again, start selling, it will start going by. So liquidity is very important as a beginner to know about. As an SMC trader, you need to know what is liquidity. Liquidity is mostly used, in fact, it kills people accounts. Okay, so there must be a real order block and there must be a fake order block. Your part is to know how to identify them on the chart. And as I say, big traders use it to have more gain, clear retail traders out and start the real movement. Okay, so that would be all for this video of SMC. If you found this video helpful and you understand most of the things I talked about in SMC that you don't know before, do well to like and subscribe and comment if you want me to go practical on this particular video. Okay, so bye guys.